Hi everyone, welcome to Chapter 9, Managerial Accounting. This is the Cengage book where we are going to talk about the variances from the standard costs. So standards are goals we set. Manufacturing companies do use these standard costs for direct materials, direct labor, and for factory overhead. Usually these accounting systems, you call them standard cost systems. They help management see what the product should cost versus what it actually costs. Now, when actual costs are compared with standard costs, the exceptions or cost variances get reported. This reporting by the principles of exceptions, sometimes called management by exception, allows management to focus on fixing these differences. There's ideal standards that are just perfect scenarios. Everything's working at 100%. Normal standards, which we consider attainable, should be able to be attained with reasonable effort. And oftentimes we review these to make sure they're acceptable. When reasonable standards are used, employees can focus more on cost and are more likely to put forth their best efforts. Standards should not be revised just because they're differing from actual costs. Standards should be revised based on extenuating circumstances. So, which of the following is a major objective in setting standards within a standard cost system? Well, the goal is to motivate employees, not discourage employees. So the master budget helps a company plan, direct, and ultimately control the performance. This control function compares actual to budget. So we're going to use a company called Western Rider, manufacturing blue jeans, that uses standard costs in its budgets. So the standards for the direct material and labor and factory overhead are put into two categories: the standard price and the standard quantity. Now, the standard cost per unit for direct materials, direct labor, and factory overhead gets computed by the standard cost is the standard price and the standard quantity. So as you see on this slide, the standard cost per pair of extra large jeans is $19.50, which consists of $7.50 for direct materials, $7.20 for direct labor, and $4.80 for factory overhead. The standard price and standard quantity are separated for each product cost. Here, the difference between the actual and the standard cost we would call cost variances. A favorable cost variance happens when the actual cost is less than the standard. An unfavorable is going to be when the actual cost exceeds the standard cost. So a report that summarizes these actual cost and standard cost and differences is called the budget performance report. So here, if we assume Western Rider produced these jeans in June, we've got 5,000 pairs of extra large, and we've got the actual costs incurred. Now, the budget performance here shows in this slide is based on the actual units produced in June of the 5,000 extra large jeans. Now, 6,000 extra large jeans might have been planned for production, but the budget performance reports based on actual production. So the total manufacturing cost unfavorable variance is $3,550, and it consists of an unfavorable direct material cost of $2,650, an unfavorable direct labor cost variance of $2,500, and then a favorable factory overhead of $1,600. Here, the total manufacturing cost variance is the difference between total standard cost and total actual cost for the units produced for control purposes. Now, each product cost variance is separated into two additional variances. The total factory overhead variance is separated into a controllable variance and then a volume variance. Since factory overhead has fixed and variable cost components, it uses different variances than direct materials and direct labor, which are variable costs. Let's take a look at another check your understanding. Which of the following is not a component of total manufacturing cost variance? The total manufacturing cost variance is the difference between total standard cost and total actual cost for the units. It's broken into the components of direct material cost variance, direct labor cost variance, and factory overhead cost variance. Let's look at one of the exercises here. Truly Delicious produces chocolate bars. The primary materials used in producing chocolate bars are cocoa, sugar, and milk. The standard costs for a batch of chocolate of 5,000 bars are shown here. Determine the standard direct material cost per bar of chocolate. So here you see we've got 500 pounds at $1.04 per pound, $520. The cocoa, the sugar, is at $60, and the milk is at $170. So the whole batch is at $750. If we divide that by 5,000 bars, we get 15 cents per bar. Here in this exercise 9.2, Designer Furniture Company manufactures designer home furniture. Designer furniture uses a standard cost system. The direct labor, direct materials, and factory overhead standards for a finished dining room are shown here. So we'll look at the standard cost for the dining room table and why we're using this type of system. So you see we've got the 30 for direct labor, $30 an hour at 5 hours. We've got the direct materials, $8 at 20 boards. The variable overhead, 75 cents of direct labor, and then the fixed factory overhead is $1.15 at direct labor hours. So our total cost for one dining room table is $319.50. The standard system, helps management use control costs. Using this principle, costs that deviate a lot from these standards get looked at and see what's going on. The standard cost system can be used to motivate employees to work efficiently. Here we've got exercise 9.3. Lanier Bottle Company manufactures plastic 2-liter bottles for the beverage industry. The cost standards per 100 2-liter bottles are shown here. And then at the beginning of January, Lanier Bottles management planned to produce 3,500,000 bottles. The actual number of bottles was 3,600,000, and we see the actual cost. So we're going to prepare the January manufacturing standard cost budget. Then we'll prepare a budget performance report and then interpret it. So here we see the manufacturing standard cost. We've got our direct labor, $1.25 times $3,500,000. Divide that by 100. Our $4.80 for the direct materials. That was the direct labor. The direct materials at $168,000, and then our factory overhead at $1.50 of the $3,500,000 divided by the 100. So when we add the direct labor, the direct materials, and the factory overhead, we're at $264,250 for standard. The difference of the actual cost that came in, our direct labor is at $46,750, our direct materials at $175,000, and our factory overhead at $52,900. So you see our actual costs are $2,850 higher than the standards, with the factory overhead actually coming in lower. So the actual costs were more than budgeted. The unfavorable direct materials and direct labor variances more than offset the factory overhead cost variance. Now, as we look at Objective 3, and we'll talk about these variances, the total direct material and direct labor variances are separated into the direct material cost and direct labor cost variances for control purposes. The standard price of $5 per square yard is shown here. The Exhibit 1 shows that 1.5 square yards is the standard quantity of materials for producing one pair of extra large jeans. So 7,500 square yards is the standard quantity of materials for producing 5,000 pairs of extra large jeans. Comparing the actual and standard cost computation shows that the direct materials unfavorable cost variance of $2,650 is caused by a price per square yard of 50 cents. That's showing more than the standard. And then we've got a quantity usage of 200 square yards. That's less than the standard. So here, the direct materials price variance is computed by the actual price minus the standard price times the actual quantity. If the actual price per unit exceeds the standard price per unit, the variance is unfavorable, which is what we saw there. If the actual price per unit's less than the standard price, then the variance is favorable. The direct materials price variance for Western Writer for June is $3,650 unfavorable. We see the actual price is $5.50, where the standard price is $5 at the 7,300 square yards. Now, the direct material quantity is actual quantity minus the standard quantity times the standard price. If the actual quantity exceeds the standard, then it's unfavorable. It's an unfavorable variance. If the actual quantity produced is less than the standard, the variance is favorable. In this case, the Western writer has a favorable variance because the standard quantity was 7,500 yards and we actually used 7,300 yards. The relationship among the total direct material cost variance, the direct material price variance, and the direct material quantity variance is shown here on this slide. You see that the direct materials quantity variance should be reported to that person who's responsible for the variance. So an unfavorable quantity variance could be caused by equipment that hadn't been maintained or inferior materials. You can't always control all variances. A price variance that's unfavorable could be due to market increases, and sometimes there's nothing purchasing can do to fix that. But if materials of the same quality could have been purchased from another supplier, maybe that variance could have been controlled. So the standard rate of $9 per direct labor hour, we took from the previous slide, and that slide indicated that 8.8 hours is the standard time needed for producing one pair of extra large jeans. So 4,000 direct labor hours, which is the 5,000 units at 0.8 hours, is the standard for producing 5,000 pairs of extra large jeans. If we compare the actual and standard cost computations, it shows that the total direct labor unfavorable cost variance is 2,500, which is caused by $1 per hour rate change and a quantity of 150 hours, which which is less than the standard. So the direct labor rate, we see actual rate per hour minus the standard rate times the actual hours. If the actual rate per hour exceeds the standard rate, it's unfavorable. If the actual rate per hour is less than the standard rate, we've got a favorable variance. In our case with Western Writer, the actual rate is at 10, the standard was at 9, at 3,850 hours. So we've got a $3,850 unfavorable variance. In terms of the direct labor time variance, we show that the actual direct labor hours minus the standard times the standard rate. In our case here, we've got a favorable variance. The actual direct labor hours were less than the standard direct labor hours. And we've got here a $1,350 favorable variance. Again, here you see the relationship among the direct labor variance. Production supervisors control the direct labor costs. An unfavorable rate could be caused by not scheduling well, not using employees as they could. If this is the case, then highly paid employees could be used in jobs that are performed by unskilled, lower paid employees, and as a result, get unfavorable rate variances. An unfavorable time variance can be caused because of being a shortage of skilled workers. Could be There could be a high turnover rate among the skilled employees. So, direct labor standards for the non-manufacturing activities. We can use these standards for all kinds of purposes. For administrative, selling, and service activities where there's a repetitive task. Standards could be developed for customer service personnel that process sales orders. When labor-related activities aren't repetitive, then direct labor time standards aren't as common to be used. So here we've got exercise 9.8. The following data relates to labor costs for the production of 50,000 cellular telephones. Determine the direct labor rate variance, direct labor time variance, and total direct labor cost variance. And what could have caused these? So we've got the actual 9,300 hours at $29.50, where the standard is 9,000 hours at $30. So we look at the direct labor, the actual rate per hour minus the standard rate times our actual hours gives us a favorable variance. For the time variance, we have an unfavorable. We actually use 9,300 hours versus the standard of 9,000 hours. So we have a $9,000 unfavorable. And the direct labor rate variance plus the direct labor time variance ultimately gives us a $4,350 unfavorable variance. Could have been they were less experienced workers who were paid less. They might have been poorly trained. As a result, lower labor rates than planned, and as a result, more hours because they weren't trained. Factory overhead costs are analyzed different than we do the direct materials and labor because there's a fixed and a variable component. Factory overhead costs are budgeted and controlled by separating into that fixed and variable component. So the budgeted factory overhead rate for Western Lighter is $6 per direct labor hour. So we take our budgeted factory overhead, divide that by normal capacity, gives us our $6. For Western Rider, 100% of normal capacity is 5,000 direct labor hours. The budgeted factory overhead cost at 100% of normal capacity is $30,000. 18,000 of it is variable, 12 is fixed. So the variable factory overhead controllable variance indicates the ability to keep the factory overhead costs within the budget limits. Because variable factory overhead costs are normally controllable at the department level, responsibility for controlling this variance usually rests with department supervisors. This slide here shows the budget of various capacities using this standard overhead rate. The variable factory overhead controllable variance is the difference between actual variable and the budgeted variable. If the actual variable overhead is less than the budgeted variable overhead, then it's favorable. If the actual variable exceeds the budgeted, then it would be unfavorable. So the budgeted variable overhead for Western, for when 5,000 units of extra large jeans are produced, is $14,400. Assume Western Rider incurred the following actual overhead costs of $10,400 variable, fixed of $12,000. We would see a $4,000 favorable variance for Western Rider. Fixed factory overhead volume variance is what would be the difference between budgeted fixed overhead at 100% normal capacity and the standard fixed overhead for what the actual units were produced. So unfavorable fixed factory overhead volume variance means that the actual units produced is less than 100% of normal capacity. So the company used its fixed overhead resources less than they expected to be used. A favorable fixed factory overhead volume variance means actual units produced is more than the 100% of normal capacity. So let's look at the fixed factory overhead volume for Western Riders at 2,400 unfavorable variance. So our standard hours for 100% normal capacity, 5,000. Standard hours for what actually was produced would be 4,000. At our factory overhead rate would show us a unfavorable variance. It's unfavorable because the actual production is only 4,000 direct labor hours, or 80% of what the normal volume is. And they look at that as unused capacity. This slide shows graphically the fixed factory overhead volume variance for Western Rider. The budgeted fixed overhead does not change and is $12,000 at all levels of production. At 100% of normal capacity, which would be 5,000 direct labor hours, the standard fixed overhead line intersects the budgeted fixed cost line. Production levels that are greater than 100% of normal capacity, then the volume variance is going to be favorable. For production levels less than that 100% of normal capacity, here we would show the volume variance to then be unfavorable. Management needs to determine the causes of the unfavorable variance and consider taking corrective action. Now, the budgeted and the actual cost for the variable and fixed factory overhead, along with the related controllable and volume variances, get reported by each cost element. That applied factory overhead for Western Rider for June is $24,000. That would be the standard hours at 0.8 direct labor hours per pair of jeans at the $6 factory overhead rate. But 4,000 hours were used at $6 an hour, which gives us the 24,000. Total factory overhead cost variance was a $1,600 favorable variance because we actually had 22,400 where the standard was 24,000. So at the end of the period, factory overhead should have a normal balance. A debit balance represents it was underapplied, and a credit balance represents it's overapplied. Underapplied or overapplied account balances represent the following overhead cost variances. Underapplied factory overhead is equal to unfavorable total factory overhead cost variance, and the over-applied factory overhead is equal to a favorable total factory overhead cost variance. The controllable and volume variances are determined as follows. The difference between the actual overhead incurred and the budgeted overhead is the controllable variance. The difference between the applied overhead and the budgeted overhead is the volume variance. If the actual factory overhead exceeds the budgeted factory overhead, the controllable variance is unfavorable. And if the actual factory overhead is less than the budgeted factory overhead, then the controllable variance would be favorable. So here's another question for us. If JB Industries produces a line of luxury home furnishings, during the most recent period, its actual factory overhead is $28,500 and its applied factory overhead is $22,700. What's the balance of the factory overhead account at the end of the period? Well, it would be under applied because the actual overhead gets debited and the applied gets credited. If the actual is $28,500 and the applied is $22,700, it got under applied by $5,800, basically ending with a debit balance in the account. Let's look at a slide here. Lino Manufacturing Company prepared the following factory overhead cost budget for the press department for October of the current year, during which it expected to require 20,000 hours of productive capacity in the department. So assuming that the estimated costs for November are the same as for October, we're going to prepare a flexible factory overhead cost budget for the press department for November using 18,000, 20,000, and 22,000 hours of production. So you see here, we can use the indirect factory labor at the $9 per hour. That's our 180,000. Divide that by 20,000 hours. The power and light is 60 cents per hour, which we get by the $12,000 of power and light divided by 20,000 hours. And then the indirect materials, the cost of the variable is 64,000. Divide that by our 20,000 hours to give us $3.20 per hour. So we can utilize this by the various levels of direct labor hour and come up with our factory overhead cost budget. Now the fixed are going to remain the same no matter what those levels are. Here, this exercise, we've got Tannin Products prepared the following factory overhead cost budget for the trim department for July of the current year, during which it expected to use 20,000 hours for production. Tannin has available 25,000 hours of monthly productive capacity in the trim department under normal business conditions. During July, the trim department actually used 22,000 hours for production. The actual fixed costs were as budgeted. And the actual variable overhead for July is shown here. So in order to construct the overhead cost variance report, we show our actual costs, we show the budgeted cost at our actual production, and from there we can see that our indirect factory labor is favorable, the variance is favorable, the power and light's favorable, but our indirect materials are unfavorable. So ultimately, we've got an unfavorable net variance of $900. We can look at our idle time. So ultimately, if we then add that to our idle time of 3,000 hours, we've got a total overhead cost unfavorable variance here of $16,500. Here's another way of viewing this, where we take our actual costs and our applied costs, and we see we've underapplied, and then we can see how we've broken that into the volume variance and the controllable variance. So the materials account is debited for the actual quantity purchased at the standard price, the $36,500, which is the 7,300 square yards at $5. Accounts payable is credited for the $40,150 actual cost and the amount due the supplier. So that difference of $3,650 is the unfavorable direct materials price variance, that $550 actual versus the $5 standard at the 7,300 square yards. We record it by debiting direct material price variance. If the variance had been favorable, then that direct material price variance would have been credited for the variance. So work in process was debited for $37,500, which is the standard cost of the direct materials required to produce the 5,000 extra large jeans. Materials is credited for the $36,500, which is the actual quantity of materials used at the standard price. The difference of $1,000 is the favorable direct materials quantity variance, because we only use 7,300 square yards, where the standard was at 7,500 square yards. It's recorded by crediting direct materials quantity variance. If the variance had been unfavorable, the direct materials quantity variance would have been debited for that variance. When goods are completed, finished goods is debited and work in process is credited for the standard cost of the product transferred. As you see in this slide, a sales price of $28 per pair of jeans, selling expenses of $14,500, administrative expenses of $11,225 are assumed here. Variances are not reported to external users. So the variances shown in that previous slide get transferred to other accounts when we prepare the income statement for the external purposes. In preparing an income statement for external users, the balance of those variance accounts get transferred to cost of goods sold. But if the variances are significant, or in many of the products manufactured would still be in inventory, then the variances should be allocated to the work in process, the finished goods, and also the cost of goods sold. So here let's look at exercise 919. Siafi Manufacturing Company incorporates standards in its accounts and identifies variances at the time that manufacturing costs are incurred. Journalize the entries to record the following transactions. So we purchased 2,450 units of copper tubing on account at $50 per unit. The standard price is $48.50 per unit. So we'll debit our materials at the 2,450 at the standard $48.50. We'll debit our direct material price variance, because it's a negative variance, for the 2,450 at $350, and we credit our payable for the full amount, the $127.4. Next, if we use 1,900 units of copper tubing in the process of manufacturing 200 air conditioners, 10 units of copper tubing are required at standard to produce one air conditioner. So in this case, we've got a favorable variance here. We transfer to work in process 200 at 10 units at $48.50, so the $97,000. Our materials only are 1,900 units at $48.50. So in this case, we've got a direct material quantity variance that is positive. This next exercise, the assembly department produced 5,000 units of product during March. Each unit required 2.2 standard direct labor hours. There are 11,500 actual hours used in the assembly department during March at an actual rate of $17.60 per hour. The standard direct labor hour rate is $18 per hour. Assuming direct labor for a month is paid on the 5th day of the following month, do a journal showing the direct labor in the assembly department of March 31st. So 5,000 units at $2.20 is the standard, would be our work in process of 198,000. Since the direct labor time variance was actual hours of 11,500 versus the standard of 11, we take that at our standard rate of $18 to come up with a $9,000 unfavorable variance. The direct labor rate variance is the actual rate of $17.60 per direct labor hour versus the $18 standard at our actual hours of 11,500, gives us a $4,600 favorable variance, and then we credit our wages payable. The following info was taken from the records of Griggs Company, and so our job is to prepare the income statement to management, so this is internal use. So here we'll start with our sales of $868,000. We get our cost of goods shown at standard of $550,000 to come up with our gross profit at standard. Then from there, we'll take our variances from our standard, our direct material unfavorable, our direct labor time, unfavorable, and then our favorable direct materials quantity and direct labor rates, our favorable variable factory overhead controllable, our unfavorable fixed factory overhead volume, to give us our net unfavorable variance, to then come up with our gross profit, less our operating expenses, and our interest expense. So this takes our standard cost of goods sold and shows how the variance occurred in the different categories. So standards can be used in non-manufacturing settings when tasks can be repetitive. Here, Marion Hotel uses labor standards to control the cost of the housekeeping staff, where a housekeeping employee is expected to clean a room in 42 minutes and is paid $13 an hour. Here, we have guest rooms, 1,050, guest room nights, I should say, and staff hours of 840 hours. So guest room nights can be translated into standard hours if we estimate we have the actual guest room nights, and we can take our standard time of 0.7 hours to come up with the staffing of 735 hours. So we can look at the direct labor time variance by the 840 actual hours minus the standard hours at $13 per hour to show this was unfavorable of $1,365. So management needs to look and see, could they have overscheduled staff? Was there not enough training? Could there have been some unique room scenarios? Who knows? Operating income gets affected by difference in what we expected the revenues to be and what they actually are. We call that revenue variance. The difference can be due to an increase or decrease in unit sales price or units sold. Now, we can look at these by the variance showing the planned selling price per unit minus the actual selling price per unit times the actual units sold. That's our revenue price variance. Our revenue volume variance is based on the difference between the planned and actual units sold, assuming no change in the unit sales price or the units cost. So in August, Noble Inc. sells one product. We plan to sell 100,000 units at $8. We actually sold $7 or 125,000 units at $7.50. So the revenue price variance was unfavorable because we planned on selling it at $8, we sold it at $7.50, and we sold 125,000 units. So the price variance is unfavorable by 62,500. But the volume variance is favorable. We wanted to sell 100,000, we sold 125,000. So the volume variance is favorable. The favorable revenue volume variance of 200,000 has the effect of ultimately increasing revenues and operating income in this scenario. So for internal reporting purposes, companies may report revenue variances separately or together with cost variances on an income statement. Let's look at two more exercises here. Rockport Industries gathered the following data for March. We've got our planned sales price of 150 versus our actual of 144. Our number of units sales planned is 12,500, where actual is 12,900 for our total sales. We'll compute the revenue price variance, the revenue volume variance, and then the total revenue variance. So the revenue price variance is the planned selling price minus what we actually sold it for times actual units is an unfavorable revenue price variance of 77,400. The volume variance is favorable. We wanted to sell 12,500, we sold 12,900 units at the standard price. And then the net total revenue variance, the revenue price versus the revenue volume, is a net unfavorable of 17,400. We take the 77,400 unfavorable revenue price from the revenue volume favorable of 60,000 to still have an unfavorable overall. Here Dickinson gathered some information. Again, what we planned for revenue was $580. What we actually sold was $6. The number of unit sales, we planned on 820,000 units. We only sold 805,000 units. So our revenue price variance is going to be favorable. We actually sold it for 20 cents more times the actual items sold gives us a favorable. The revenue volume is what we planned to sell versus what we actually sold times our standard. And overall, though, we actually show a favorable, our 161,000 revenue price variance versus our unfavorable revenue volume variance does net us with a total revenue variance of a favorable 74,000. So I hope this has been helpful. I look forward to seeing you in Chapter 10. Goodbye, everyone.